Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden, and these are your top stories this morning. Global stocks hold on to gains as the US president signs a bill ending the longest government shutdown in history. But it could take weeks to clear the backlog of federal bureaucracy. Here in the UK, GDP data is set to show the economy slowing as the Chancellor sets out her plan to cut inflation. Plus, we speak exclusively to Ukrainian President Volodymyr Zelenskiy as Russia's war in the country rages on. That interview coming up at 6:30 a.m. London time. A very good morning. Well, we kick off the programme in Munich with earnings out of Siemens, and it's a big net income beat for the fourth quarter here, coming in at 3.09 billion euros. The expectation was for 1.93 billion euros. They see comparable revenue growth for 2026 at 6% to 8%. And this, of course, off the back of the news that we broke last week that Siemens is looking at handing a large stake of Siemens Healthineers over to its own shareholders. So we're looking for an update on the strategy on that. We'll listen out for it in the investor call later on today. We'll also be speaking to the CEO himself, Roland Busch. So that conversation coming at 6:40 a.m. London time right here on Daybreak Europe. The shares up about 34% so far year to date. Checking in on these broader markets, and the Sharpie ink is dry. The US government shutdown is over, and you are seeing global stocks holding on to their gains as a result. So European futures up 0.3%, S&P E-minis up 0.2%, modest gains only in the Asia session. But flip the board over because, of course, now attention turns to what the Fed is going to do with all that data of which it has been starved when and if it comes. We've got the 10-year US Treasury yield here at 4.09%, euro dollar at 1.15, gold still above that $4,000 a troy ounce level, 4,208 is where we trade, up 0.3% as we let go of those safe havens perhaps, and Brent here at $62 a barrel. The slide continuing on the oversupply concerns flagged by OPEC, so down 0.2%. But let's get into the details of that US government shutdown. President Trump has signed the legislation to end it. It's been the longest government shutdown in history, and it marks the end officially to this 43-day impasse. The shutdown halted food aid to millions of households. It cancelled thousands of flights, and it forced federal workers to go unpaid for more than a month. President Trump says that he's pleased a deal has now been done.
I'm always willing to work with anyone, including the other party. We'll work on something having to do with health care. We can do a lot better. We can do great. So much money is involved, and we're willing to pay so much money to the people. So we're going to pay a lot of money to the people. They're going to go out and buy their own health care, and we're going to forget this Obamacare madness.
Let's get analysis now with Bloomberg's Rosalind Matheson. Morning, Ros. So how did the bill get over the line in the end? Because there were doubts whether it would get past the House. And are we going to go back to square one in January?
Well, that's right. As you say, this really was started because a small group of Democrats peeled away and engaged in negotiations with the Republicans to get a deal that would, at least for now, allow the government to reopen. And it was a relatively tight vote in the House, but obviously it did get through. And as you're saying, what this does allow now is the process to begin. And so government workers perhaps coming back as soon as Thursday, getting back pay as soon as Saturday. Importantly, low-income Americans starting to get food aid again, and it funds some government departments for a longer period, but most of it, as you were saying, only to the end of January, and forbidding government layoffs only to the end of January. So in a few months, are we going to be back in the same position again with these conversations happening, the risk of another shutdown so soon after this one? Because, of course, the key thing that this bill does not do, and this is quite contentious, of course, is it doesn't bake in any kind of guarantee around the extension of tax credits for Americans for healthcare under Obamacare. There's a promise maybe of a consideration of a vote in the Senate at some point, nothing beyond that. And so for a lot of Democrats, that's really crucial. So are we going to see this all come to a head again within a matter of months? And so this shutdown, this could be back on the agenda again as soon as the end of January.
Yeah, so you've talked, Ros, about some of the ways in which the wheels of government will get back to speed. But for markets, of course, the crucial thing is, when's the economic data going to be released?
Well, that's right. I mean, a shutdown's a bit like a very large ship. So it shuts slowly and then it restarts again slowly. It doesn't turn very fast. So you've got the machinery of government having to begin again, people physically having to go in, turn their computers on, start again, reopen government counters, and so on. So you've got a whole lot of things that could take a while to flow through. The resumption again of food aid could take a week or so. Some of the issues around air travel could take at least a week or more to wash out, hopefully by Thanksgiving. And the question of a calendar, for the markets of what kind of data are going to be released and when, particularly as some of those October data are going to be released at all. It seems possibly that they won't be released at all. So there'll be a bit of a gap there in the calendar for markets to figure out. You then get a cluster of data that really is kind of backing onto each other. And that's a harder way to find a picture of the economy, because really what we want to understand is what was the impact of this shutdown on the economy, on things like jobs and hiring. Is there going to be a longer term washout of that? And so for markets, it's going to be quite difficult to pass that, particularly if we don't get all the data that now start to come out.
OK, Bloomberg's Ros Matheson, we thank you so much. And we now go to Bloomberg's Valerie Teitel for more on that market reaction. Val, is it simply that the shutdown's ended and markets rejoice?
Well, look, there's still a buoyant mood when it comes to equity markets. The U.S. equity market, when you're looking at S&P futures, is headed for its best week in 3 months. So essentially, this is really keeping the positivity after a really bad week for the equity market last week. The NASDAQ had its worst week since April. So this risk-on mood is continuing. Obviously, some of those AI earnings, those tech earnings, have really helped sentiment as well. There's not been a lot of movement when it comes to the Treasury market. On this, though, there has been a lot of movement this week in gold. And I think this is very interesting for the market. Gold is up nearly 6% in the last 5 sessions. And this goes back to the theme of now that the government is reopened, the U.S. Treasury will be resuming payments back into the economy after building up a cash balance over the last 43 days. And that kind of resumption of liquidity is both positive for the equity market and is something that is positive for a driver of gold as well. So gold and the equity market on a front foot after this bill was signed.
So tell us more about what's happening with the data here, because we've had the White House suggesting that actually there won't be any for the month of October. Let's just take a listen to what the Press Secretary Caroline Leavitt had to say.
The Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released. And all of that economic data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period.
So as Ros was suggesting, could it be that the Bureau of Labour Statistics saves the day here?
Well, look, if we look at what the Department of Labor has said, they will be back to full operations today. The Bureau of Labor Statistics operates within the Bureau of Labor. So we could potentially get an update today on what the BLS plans to do, both with this data backlog and with Caroline Leavitt was talking about what they intend to do with the October CPI release. Now, this one is more pivotal here because of the government shutdown. They've not able to collect the November CPI data. That does involve a lot of people knocking on doors and speaking to businesses. However, if we look at the October NFP report, that is very likely to still be released. The establishment survey, which is the headline non-farm payroll number, comes from that, is essentially not done needing to be knocked on doors. However, the unemployment rate, that's the household survey, does take some labor force effort. So there still could be some issues with the data moving forward because of these data lapses. But we're essentially waiting to hear anything from the Bureau of Labor Statistics, either confirming what the White House told us yesterday or not. But as I mentioned, the Bureau of Labor Statistics is back to full operations today. So we are perhaps it's in the realm of possibility that we still get a non-farm payroll release on Friday. That September non-farm payroll print was mostly put together before the shutdown had begun at the beginning of October. So that's essentially something they just need to release back to the markets.
OK, well, that list that we just saw on the screen looked a bit like Valerie Teitel's Christmas list, but we'll keep our fingers crossed for that data. Val, we thank you so much. Now, let's hone in on the Asian market reaction. We can go now to Winnie Sue. What's happening where you are, Winnie?
Yeah, it seems like the Asian market is actually not doing a whole lot today as investors look past that news around the U.S. government reopening. But here we are seeing some moves in the individual markets. For example, for Australia, we got that stronger than expected jobs data, which helped investor pare back those expectations for the rate cut to come next year. And hence, we're seeing stocks down about 0.5%, and also the 3-year yield jumped by 10 basis points. For South Korea, we are closely watching the Korea won as it rebounded a little bit from its recent weakness, but still we are about 1% away from that weakest level since 2009, and hence a bit more concerns around the intervention risk. And speaking of the intervention risk, another key currency that we are watching is the Japanese yen. And you flip the board and take a look at what's going on with the Japanese market. So the Japanese yen here not doing a whole lot, but we are hovering around that 155 psychological level that is being closely watched. Now, this time around, things are a little bit more complicated because of Prime Minister Takaichi's policy being a bit more around fiscal expansion. And that concern is also weighing on the appetite for the bond sales. And this today we were seeing the 5-year bond sales slightly lower, appetite slightly lower than the 12-month average, which is in line with what we saw for the 30-year bond auctions earlier this week. Now, we also take a look at what's going on with the Chinese market, because attention is also shifting to the key earnings that we're expecting today, especially from key companies Tencent and JD.com. So both companies were seeing shares down a little bit and also dragging down the overall tech sector. For Tencent, we are expecting a bit more of a modest profit gain, about 5%, and the attention will be focused on the monetization around the AI front. For JD.com, a little bit less rosy picture because we are expecting some profit slump when it comes to the impact of the fierce price competition of its food delivery business with other peers. Back to you, Lizzie.
All right, Winnie, thank you so much. Winnie Su in Hong Kong. And of course, that is a key item on the day ahead. Let me take you through what's on the docket for today. First of all, at 7 a.m. London time, we're going to get those third quarter GDP numbers from the UK. We'll also have earnings from Burberry, a fuller picture of luxury's recovery, but a lot of focus on this brand at the moment, given its turnaround after that last show as well. And then, as Winnie mentioned, we get Tencent earnings out of Asia and Disney earnings from the US as well. But you can get a roundup of all the stories that you need to know to get your day going by looking at today's edition of Daybreak, which terminal subscribers can find by going to DAYB Go. Coming up on this programme, though, we'll look at market reaction to that US government reopening with Yael Selfin, chief economist over at KPMG UK. That conversation coming up next. And later in the programme, we're going to speak exclusively with Ukrainian President Volodymyr Zelenskiy. So do stay with us for that conversation. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, with the longest ever US government shutdown in history coming to an end, hopes that the government could soon publish key economic data were muted by the White House Press Secretary Caroline Leavitt, warning that jobs and consumer price index reports for October are unlikely to be released due to the shutdown. Well, Yael Selfin, Vice Chair and Chief Economist at accounting firm KPMG UK, joins me now for analysis. Does it matter, Yael, that we might never see these reports?
It does matter because there's a lot going on in the US, especially now with the tariffs. There's quite a lot of change and also changes in the labor market. The data that we get will be very important to just understand how the economy is transitioning. We've got the other data sources, and the Fed is using other data sources, so they're quite confident. They do have some information. They are not running blind. But this is an additional set of data which is fairly comprehensive. It's very hard to get such comprehensive data from private sources.
Yeah, well, when you look at those private sources, what do you expect that the official data would have said about, for example, particularly the labour market?
So it is possible that we have pockets of relatively tight labour markets in some sectors and some regions, and that may not be seen in some of the private sector data report, especially when you look at the lower level employment or lower remuneration level, especially the areas where the restriction on migrations have been impacting most.
So what are you thinking about the Fed next month then? Because, of course, the FOMC very divided right now.
I mean, I think it is touch and go at the moment. Generally, I think it is possible that the Fed is a little bit too dovish, because I think, especially when it comes to inflation, we could see more of that with the tariffs coming up later on. It takes time for businesses to adjust for those increasing costs. We haven't seen a lot of it passing through at the moment, and I think we could see more of that next year.
OK, so you're worried about inflation in the US. What about in the UK? We just had a BOE decision on a knife edge. We've got GDP numbers coming on later today. What's your outlook for the UK? Are we going to get a rate cut in December?
I think a rate cut in December is more or less given now. We were always expecting a rate cut in December, generally, just because we're expecting inflation to go back to target a little bit earlier than the BOE. Because when you look at the data, when you look at regulated energy prices, for example, we're expecting that to be weaker just because of the Ofgem decision. We're also expecting food prices to moderate as well, whereas with core prices, especially service prices as well, we could see that a little bit more persistent, but generally, overall, the picture is likely to be a little bit more moderated. So I think the BOE may be a little bit too concerned at the moment when it comes to inflation.
Well, that's interesting, because we've reported this morning that the Chancellor is planning to cut household bills via regulated prices to bring down inflation, and then try to persuade the fiscal watchdog, the OBR, to give her a bit more headroom. I wonder, what could she do in this budget to derail a December cut from the BOE?
There's a few things she could do. I mean, if she raised VAT, for example, that will have an immediate impact on inflation, even though you would argue this is transitory, it will pass after a year. But the BOE will be concerned about the inflation expectation as a result of it. Also, if she increased costs for employers, they are more likely to pass it through.
Again.
But it looks like most of the burden is going to go on households, and that is deflationary, if you like, because it means that it will hit demand.
We also had the news yesterday that there could be a Prime Minister streeting. The Health Secretary Wes Streeting, reportedly, according to us, challenging Keir Starmer for the leadership behind the scenes. He's denied it, but I wonder, even if it's on the back of an envelope, Yael, have you been modelling what a streeting economy might look like?
I think what you will have is more uncertainty, potentially, which is definitely not what you want for the UK economy. You want business investment to start recovering. We have seen relatively strong business investment in the UK, but it's driven by a couple of sectors. The rest of the economy hasn't seen a boost to investment, business investment for a while. So we really need to get that going more generally.
Well, yeah, on a global note, we're all waiting for gains in productivity to come out of this AI capex. When are we going to see it?
We will probably see some of it. Our estimation is that the increase to productivity would be about 0.1% per year. So it is a little bit more modest than what most analysts would expect. But it could take time. It could take up to 10 years for AI to be fully embedded in our production processes. So we need to be patient there.
Years. OK. Yael, we'll wait for that. Yael Selfin, Vice Chair and Chief Economist at KPMG UK. Always a pleasure to have you with me on the early shift. We thank you so much. Well, coming up on the programme, the UniCredit CEO on why Europe needs bigger and stronger banks. All the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to an update on global news from around the world. Democrats are again pressing President Trump on his ties to the convicted sex trafficker Jeffrey Epstein, highlighting emails that suggest the president knew of Epstein's activities. A congressional committee released 20,000 pages of documents, including emails that appear to allege that Trump spent hours in a house with one of Epstein's victims. Trump posted on Truth Social that Democrats are trying to bring up what he calls a hoax to deflect from the government shutdown. Meanwhile, the House Speaker Mike Johnson says that a vote will happen next week on legislation to compel the Justice Department to release the files on Epstein. Elsewhere, Bloomberg understands that the European Union is drafting a plan to implement the next phase of their summer trade agreement with the US. The push comes with the EU's trade chief, Maroš Šefčovič, due to meet his US counterparts later this month. The deal, agreed in August, set a 15% tariff on most EU goods entering the US, but also included pledges to keep working on issues like steel exports and non-tariff barriers. And staying with trade, top trade negotiators from Switzerland are heading to Washington, hoping to complete negotiations on a deal to lower tariffs. President Trump introduced a 39% levy on Swiss exports in July, among the highest duties in his global trade reset. Switzerland hopes it can lower the US duty on its goods, including watches and chocolate, to 15%. Now, to one of our top interviews. The CEO of UniCredit says that Europe needs bigger and stronger banks to help finance the global transformation. Andrea Orcel's comments come after his takeover bids for Banco BPM and Commerzbank ran into government opposition. He was speaking on a panel at Bloomberg's Future of Finance conference in Milan, moderated by Francine Lacroix.
We get trade wars, we get real wars. So completely different from what it was in the past. And on that, now we're overlaying disruption from a technology standpoint that is truly affecting the way we do business. If the world, but in particular Europe, needs to change, they need financing. If they need financing, they need banks. And we need larger, stronger, more capable banks to accompany that transformation. But the point is, in as much as we are the bank in Europe with the most optionality on M&A, because we are in 13 markets and we can do multiple transactions in every market, at the same time, unfortunately or fortunately, we're disciplined and determined not to disappoint our shareholders, so we will not move in things that do not generate value.
So you dropped your bid for Banco BPM. Do you still want it?
We closed the chapter on that. We tried at certain terms. For a number of reasons, it was not to be. We closed it. For UniCredit, this is exactly how we see the next 3 years. We think there will be a lot of dislocation, and that is a great opportunity for us.
Why is bigger better? You've been on the acquisition trail. Again, what's the guiding thread on why you think you can better service your clients?
Well, look, I think, especially in the last year, but actually since I got here, there has been this acquisition trail topic that has been there all the time. And every time we have disappointed people because we actually weren't on the acquisition trail. In 21, we did not proceed with Monte dei Paschi. It was an interesting acquisition, but we said very clearly the value we can create standalone is multiple times. I think the point is that, and I've done a lot of it, M&A is not a substitution for getting an organization that is capable to grow profitably, and do so while they're gaining market share and they're returning to shareholders disproportionate returns.
So that was the UniCredit CEO, Andrea Orcel, speaking at Bloomberg's Future of Finance event in Milan. Well, coming up on the programme, we'll speak exclusively to the Ukrainian President, Volodymyr Zelenskiy, in Kyiv. That conversation coming up next. Plus, I'll be speaking with the CEO of Entrepreneurs First about how it's reshaping Europe's tech scene. Stay right here. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Global stocks hold on to gains as the US president signs a bill ending the longest government shutdown in history. But it could take weeks to clear the backlog of federal bureaucracy. Here in the UK, GDP data is set to show the economy slowing as the Chancellor sets out her plan to cut inflation. Plus, we speak exclusively to Ukrainian President Volodymyr Zelenskiy as Russia's war in the country rages on. That interview coming up soon. But let's check on the markets first, shall we? This Thursday morning, and the shutdown is over. Global stocks holding on to gains as a result, within touching distance of record highs. You can see futures pointing higher on both sides of the Atlantic, and in the Asian session we've seen some modest gains already. Now, if we flip the board over to the cross-asset picture, of course attention now turns to what the Fed will do when or if it gets the data of which it has been starved. So we've got gold rising on rate cut bets. The 10-year US Treasury yield there at 4.09%. Euro dollar a touch weaker this morning, and Brent at $62 a barrel. Pretty steady, having plummeted on the oversupply signals out of OPEC. But let's get to that top interview now. The Ukrainian president wants frozen Russian assets to be used to fund the next stages of his country's war against Russia. In an exclusive conversation with Bloomberg Television, Volodymyr Zelenskiy says that fresh European funding using Russian funds is critical for sustaining his country's war effort, ramping up the pressure, really, on Brussels to end the long-running divisions over that plan. He's been speaking to our chief European correspondent, Oliver Crook, in Kyiv.
We need it very much. This is one of the types of real sanctions. Russia has to pay for this war. They began this war and they have to pay. This is a real fact, how they can pay. And we need this money. We will spend this money on renovation. And of course, we need air defense. And we need air defense from the United States. And we have European systems. We need this air defense from European leaders. This is all very important. And of course, we need to finance our drone production, which is huge. We need to finance it, and we don't have additional money. And this is the way, and this is fair, I think. They began this war, and they want to continue it. That's why they have to pay.
Is this the most significant thing European leaders can do right now to help you?
Of course, we can get more than 140 billion for today. Right. We can get it. By the way, from the United States, it will be also a good signal, like with energy, like sanctions of the White House, of President.
What?
Yes, it's about Lukoil and Rosneft and Lukoil. Important step. Yeah. And it brought some our partners, European partners, also to some strong decisions. And we've been happy that there have been 19th package. We are thankful to Europeans for this. Yeah. So that's why if President Trump, for example, will decide that he has more than 5 billion he has of assets, maybe he will decide to spend this money. It will help.
Have you discussed alternatives with Russian allies about Russian assets if that does not come through? Is there an alternative plan? Is there a plan B?
No, they understand that we need their support, and I hope, God bless, we will get this decision, but if they will not have this decision, of course, we together will find we have to find alternatives. It's a question of our surviving. That's why we need it very much, and I count on partners.
And on the question of, you brought Donald Trump in connection to the Europeans, why did it take Donald Trump to get the Europeans to ban Russian LNG?
He always said that he wants Europe to put sanctions on Russian energy. He always said that was during our meeting and etc. And that some countries in Europe, they really used it. Yes, it was not the case of 1 year. In the case of, I think, about 30 years, they had relations and a lot of different factories. They have common businesses. It's understandable. And then President of the United States, he said, okay, I'm ready, and if Europe will be ready. And of course, this decision, this way of sanctions was good. As I said to you, that it was American sanctions and European sanctions. It split, and they came together. And I think this is good way. It was good way. And that's the same about assets. That's why I raised it about assets, that there are some assets in the United States. If the United States can do it, it will be helpful for European decisions also.
So that was the Ukrainian President Volodymyr Zelenskiy speaking exclusively to Bloomberg's chief European correspondent Oliver Crook. And let me add that partway through that section, Oliver inadvertently misspoke when he asked Zelensky whether he'd discussed alternative plans with Russian allies about Russian assets. He meant, of course, to say that if he had discussed alternative plans with EU allies about Russian assets. But we thank Oliver for that conversation. Now, the Palantir UK head, Louis Mosley, says that Ukraine is, quote, the bleeding edge of military tech. Now, he's been speaking to Bloomberg's Tom McKenzie for the next episode of Bloomberg Tech Europe about how AI is reshaping defence.
I think we're living through two big global changes. One is geopolitical and the other is technology. The interesting thing is they're happening at once. So you've got the world moving to a much more, let's call it the moment of American unipolarity is over. There are now adversaries, particularly China, that are near peer or even potentially stronger than the US in certain ways. So that's a fundamental geopolitical shift. But at the same time, you're seeing a revolution in artificial intelligence, technology which will change every aspect of our lives, not least defense and military.
And you can see more of that exclusive conversation with Louis Mosley in the next episode of Bloomberg Tech Europe, which airs tomorrow at 6:30 a.m. London time, right here on Bloomberg TV. The focus is on defence and how AI has upended the industry. Tom McKenzie is speaking to key players, including the co-CEO of Helsing and the managing director of General Catalyst. Now, staying with tech, Entrepreneurs First is a global talent investor which aims to speed up Europe's tech growth by supporting founders to build startups outside of traditional hubs. Now, they say their portfolio of ventures is now worth over $13 billion and that it aims to provide a pipeline to US capital. Joining me now for more is co-founder and CEO Alice Bentinck. Alice, really good to have you with us this morning. I think you're in San Francisco. We've already lost you to the United States. I appreciate that there are deeper pools of capital over there, but I am wondering, isn't it valid for Europe to want to keep its entrepreneurs here?
Yes, good morning or, good evening, currently still in San Francisco. Thank you for having me. So one of the things that we are very passionate about at Entrepreneurs First is helping European talent build enormous, globally important businesses. And as you said, we've already built $13 billion worth of companies. And we do this through this very unusual process where we take individuals before they have a company, before they have an idea, and help them find their co-founder, develop that idea, and invest in them. And in the last 18 months, we did make a strategy change, which now means that every company we build, we take out to the US for a 3-month period. We bring them out to San Francisco, and that's really for two reasons. Firstly, it's to access the venture capital ecosystem here, which is very rich in every sense of the word, both in terms of the quantity of capital, but also the depth of experience of the investors here. But I think one of the bits that we're also really keen...
Yeah, we'll go on. I'm just wondering, that it sounds a bit like Europe's going to become the back office.
One of the things we're keen to push is the idea that we need to build a bridge between the two ecosystems. When you look at the different ways of building companies, the number one thing that matters is building a global company from day one. And we're already seeing in our portfolio, there's many different ways to do this. Some of our founders do move to the US, raise from there and permanently stay there. But we have amazing companies that have also either built the product in the UK and targeted the US market. A company called Clio, which is one of the fastest growing fintech companies in Europe. This is a company that serves the US market, is making more than $250 million of ARR, is EBITDA profitable, but is HQ'd in the UK, in London, and has built the team here. Or a company founder, someone like James Dackham, who is actually building 2 companies in Europe, a company called CoMind and Flux, which are funded by some of Europe's great VCs, such as Plural and Local Globe, but started off as a health tech company targeting the US market. So I think it's really about accessing US customers as much as it is about accessing US VC.
OK, I mean, what's the evidence that Europe's getting value back here and not just suffering brain drain? Is there anything that the likes of Julia Hoggett at the London Stock Exchange could do to persuade you that London's a worthwhile place to list?
What we're focused on is building that bridge. And I think often when we talk about startups, it has a nationalistic undertone. Yes, of course, we want to build the ecosystem in the UK. And I've spent the last 10 years building the ecosystem in the UK and have seen enormous progress and depth in the ecosystem there. But I think we also have to recognize that the US has, and the Bay Area has, one of the most developed and unique and successful ecosystems in the world. And so rather than pitting those ecosystems against each other, we need to actually connect those ecosystems and build a bridge between the two, sharing both companies, capital, talent, and seeing the flow of those things go in both directions.
OK, so it's not a one-way street. You co-founded Entrepreneur First with Matt Clifford, who, of course, was the official advisor on AI to the UK Prime Minister Keir Starmer until June this year. Aside from the listings environment, do you think that the UK government's doing enough to make sure that the UK doesn't get left behind when it comes to this AI boom, behind the likes of the US and China?
The UK has done a great job at becoming one of the best places in the world to start a company. It's so easy to set up a company here, hire here, and amazing tax breaks such as the SEIS seed investment scheme that gives tax breaks to angel investors has been a massive, massive support to building the ecosystem here. As ever, my message to the government would be immigration matters, and the more that we can support highly skilled individuals, technical individuals from the world's best universities getting access to the UK, that's really what underpins our tech ecosystem. So making sure that European founders, British founders have access to the world's best talent is super, super important.
Well, let's see if the Chancellor hears you at this upcoming budget. Alice, thank you so much for staying up late for us. That's Alice Bentinck, co-founder and CEO of Entrepreneurs First. Well, coming up on the programme, we'll hear from the Siemens CEO, Roland Busch, after the company set new near and medium-term financial targets amid a revamp that includes a radical trimming of its stake in Siemens Healthineers. That's next. This is Bloomberg. Welcome back to the programme. Now, at the top of the show, of course, we broke earnings from Siemens out of Munich. Just to remind you, they've set new near and medium-term financial targets. This, of course, amid a revamp that includes trimming its stake in Siemens Healthineers. Well, Anna Edwards has been speaking to the Siemens CEO, Roland Busch, and we can get his outlook on the year ahead now.
The midterm target we increased even to 6 to 9%. This, by the way, excludes Siemens Healthineers. And as I said, the reason is that we have highly competitive offerings due to our long-term investment, for example, in our software suite. We invested 28 billion in our software suite, which is today in industrial software, maybe the most competitive one. If you want to build a digital twin of anything, we can build it for you, the most comprehensive physics-based digital twin. And we invest in AI. We talk about investing in AI technology in the next 3 years, $1 billion. And it's not new to us. We do that for many, many years. We have a lot of offerings already, but we are doubling down on AI. And we talk industrial AI. We bring AI now to the industrial world. So when we are serving very strong markets, we are serving the digital markets. They grow faster. These markets grow by 11%. We are investing and growing in the regions, the key regions, United States, China, India. And we are also doubling down on what we do in Germany, by the way. And we are investing and growing in verticals. We have growth verticals, which are super interesting, like semiconductors, big growth verticals, pharmaceuticals. This is a business, a market which is in its transformation. Data centers, and just to name a few.
Yes, you've named a few there. And tell me about which of the client segments that have the most appetite and the most to gain from investing in your AI solutions. To be very honest, this cuts across all industries.
The point is, if you really want to increase your innovation speed, like we do, but also for our customers, this is relevant, if they want to lower their cost, if they want to drive their productivity, if they want to shorten their innovation cycles. And the only way is digitalization. And what we talk about, we are talking about our strategy, which is combining the real and the digital worlds. What does that mean? You start when you plan a new factory, for example. You build it twice. First in the digital world, in all details. The building, the plant, the machines on the site, even the people. And once you have it, then you build it in the real world. This goes faster, saves you energy, 20%, 25%, higher productivity, higher output.
Healthineers is a business that you're going to take part of and do a direct spin-off, around 30% of it going to be handed back to shareholders. Can you tell me about the rationale and the reason for doing it in this way, the reason for choosing this solution for your Healthineers stake?
Yeah. So first, we are doing that out of a position of strength. Strength for Siemens, but also for Siemens Healthineers, a business which is doing very well. But we recognized that the market, but also the businesses, they are drifting apart. For example, Siemens Healthineers is going more and more into clinical part, into therapies. Digitalization does not scale in the healthcare space for regulatory reasons. It's very much regional, as it does for our Siemens business. We're also talking about the growth. We want to unleash our growth, go for the next growth level. And we believe we can do that if we separate more, and every company can allocate capital according to their needs even better.
Siemens CEO Roland Busch speaking there with Bloomberg's Anna Edwards. Just one of the set of earnings coming out this morning. We're also getting Burberry later on today. But switching from the micro to the macro, the latest GDP numbers will be out for the UK very soon, less than 2 weeks ahead of Chancellor Rachel Reeves' upcoming budget. Bloomberg Economics expects GDP growth to slow even further over the third quarter to 0.2%. And we can get more on this with Morwenna Coniam, co-editor of Bloomberg Markets Today blog. Morwenna, what are you expecting from these numbers? And more importantly, what are they going to mean for the market and the BOE?
Well, as you say, economists are estimating that we will see a slower rate of growth than we did in the last quarter. No chancellor wants to see that, no. Particularly, less than 2 weeks before their budget. But that said, it probably doesn't make a huge amount of difference in terms of what she can actually do in this budget. She would have already had the OBR's assessment. There may be some tweaking. In fact, we had some interesting reporting today about what might possibly be going forward. I think what overall it will do is affect the reaction to what she announces. If she can argue, look, I'm doing this and the economy is growing, that can justify trying to sort of grow her way out of what is quite a tight headroom she's left herself with. I think growth is something that the government have continually stressed as being their primary objective, and we heard that from her again in her speech just last week. And I think really, a better than expected result would give her a lot more confidence going in. And of course, if it's worse than expected, it does become very tricky indeed.
Yeah, we report this morning that she's looking to woo the budget watchdog, the Office for Budget Responsibility, by trying to cut inflation, so then they could give her some more headroom at the budget. But let's see whether her plans actually add to inflation at the budget. But of course, we already had these unemployment numbers earlier in the week. Pretty painful for the Chancellor, 5%, the highest since the pandemic. And then when you think about the BOE story as well, how much could this GDP print actually move the dial for them? Such a knife edge they were on last time.
Yeah, and it's interesting you say that, because I think what we saw from Governor Andrew Bailey after the announcement was made on the most recent Bank of England meeting was he just said, I want to see more data. Particularly, he was talking about inflation, but he did also note that there would be, more inflation readings coming, but also that we have this GDP report. That this is important. I think if they see, weaker growth, that's actually going to perhaps up the ante for the case for a cut. If it's better than expected, I think that it all flows, into the bigger picture. So I think what Rachel Reeves is obviously hoping, if what we have reported on this morning does, get approved, is that she will help lower inflation, and that would give the Bank of England more scope to cut rates, which would bring the interest rates down on the government debt, and that would then give her more room to do more of the sort of measures I think that the government would like her to be doing, not cutting welfare, and, actually finding the growth to generate the money for the government's plans rather than taking it from the taxpayer.
So maybe there's a way that she could please economists, markets and her own party. Morwenna, the ball is in her court. We'll look forward to that coverage of the budget on the 26th of November. Morwenna Coniam, co-editor of Bloomberg's Markets Today blog. Now to some other stories making news this morning. UK property surveyors have painted a picture of a housing market cooling rapidly in the run-up to that budget as fears of tax rises weigh on both buyers and sellers. The Royal Institution of Chartered Surveyors said that its index of homes put up for sale deteriorated to -20 in October, with the market in a holding pattern. Elsewhere, Scotland has been assigned its first ever credit ratings, paving the way for its debut bond sale. S&P has rated it AA, while Moody's has assigned an AA3 rating. Both investment grades are the same as that of the UK. The administration in Edinburgh has previously said that the first sale of Scottish bonds, which have been nicknamed kilts, could take place before Scottish parliamentary elections in May. We've got plenty more coming up for you, so stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, in just a few minutes' time, we're going to bring you the latest UK GDP numbers for the third quarter. The expectation is that we'll see a tick down from 0.3% in Q2 to 0.2% in Q3. And this, of course, all important for the Bank of England, that last decision on a knife edge, but also will be important, the Chancellor's budget on the 26th of November. Now, flip the board over because we can see where gilts are at the moment. You can see we've had the term premium on 10-year gilts climbing more so than global peers. So what can the Chancellor do about that? Interesting insight from Bloomberg Economics yesterday saying if she can increase her fiscal buffer, actually that 10-year yield could come down by 50 basis points by the end of the decade. So she'll be hoping she can pull that off. Just flip the board over one more time, though, because one question is, will Rachel Reeves still be in place by the budget? A dramatic one, but we did see a challenge from the Health Secretary, Wes Streeting, for the top job at number 10 Downing Street. He's denied it, of course, but this is how the pound reacted yesterday. Just a few charts to set you up for your day. We've got plenty of interviews coming up for you this morning. We'll be hearing from the CEOs of Bilfinger and Fincantieri. That is on the opening trade. Does it for Daybreak Europe. Guy, Anna and Critty will take you all the way to the cash open. So stay with us. This is Bloomberg.